Good morning, ladies and gentlemen. Welcome to our second webinar for this year, and hopefully the last one as well. We will definitely consider a face-to-face roadshow in the near future. We know some of you are dying to get out of your stay-at-home clothes or pajamas to get a nice cup of coffee and socialize a bit. For today's webinar, STANLIB Namibia's Head of Distribution, Tjivingurura Mbuende, will provide us with a brief economic update for Namibia. And to help you make sense of the current market, STANLIB's Head of the Absolute Returns team, Marius Oberholzer, will talk to the Standard Bank Namibia Inflation Plus Fund, who will be standing in for Vaughan Henkel, who resigned unfortunately. And the Senior Portfolio Manager of the Fixed Income team, Sylvester Kobo, will talk to the Standard Bank Namibia Income Fund. Their conversation will outline current risks in the markets, whether there's a further upside, and discuss the fund's strategies and outlooks. So the house rules for today will be the webinar will only be until 12 o'clock. We will handle all questions at the end of the webinar. Please post your questions in the Q&A box and not on the chat function. And all questions not answered will be sent to the portfolio managers and they will answer it afterwards, and we will send it via mail within this week. So sit back and relax. And without further ado, I will hand over to Shivi. Shivi, over to you.
Okay, thank you so much, Zandria, for that introduction. So I will kick off with the Namibian economic update, and then I'll hand over to my colleagues, Marius and Sylvester, who will be taking us through the Standard Bank Namibia Inflation Plus Fund views, as well as the Standard Bank Namibia Income Fund views. So when one looks at the Namibian economy, we've seen quite a bit of diversification over the years. So if we look at the 2020 numbers, one basically sees that although government still remains the single largest contributor to GDP, that is both in terms of public administration and defense spending, but also in the education sector. We have seen over the last sort of 7-8 years where education has been the biggest expenditure line item in terms of government expenditure, which has also significantly contributed to GDP. However, one of the areas that has improved quite substantially is the manufacturing sector, which is now 11% of GDP. And we're also pleased to see that the agricultural sector has grown from about 4% a couple of years ago to 8% last year. And this is quite important for us as a nation, because although the agricultural sector only contributes 8% of GDP, in terms of employment creation, it basically employs 23% of Namibians. So there's huge multiplier effect in the agricultural sector. Mining and quarrying, we've seen, has also remained pretty much static. We saw some contractions last year, and we have also seen, we are hoping to see an increase in diamond production, especially as Elizabeth Bay mine, which has been in care and maintenance since 2019, comes online. In terms of our GDP, so this is an annual growth rate. This is basically over a 10-year period. And here we see that throughout most of the 90s, since independence, our economy has done okay. On a year-on-year basis, our annual growth rate has been quite good. Pre-2016, we hovered around 5-6% levels in terms of economic growth. However, we need to remember that a lot of this economic growth was driven by debt and government expenditure. And we saw in 2016, when governments basically stopped spending, reduced several projects in the economy, we saw that we had been in a recession because in 2016, we still had an over-reliance on government expenditure. However, in 2020, we've seen the deepest contraction that we have seen in recorded history. So the economy last year contracted by 8%. And that was largely driven by both the hard as well as the soft lockdowns that we had last year, which impacted several sectors of the economy. So if one looks at the primary and tertiary sectors of the economy, they make up around about 6% respectively. But if you add the two sectors together, they make up 70% of our GDP. So last year in 2020, we saw that there were travel restrictions, our borders were closed, so hotels and restaurants, tourism was down, and that sector was down 33%, followed by transport as well. However, when we look at it on a positive note, fortunately, we've seen the health sector starting to increase, the information communication sector also increasing, as well as agriculture and forestry. However, these sectors contribute substantially lower to our GDP, and therefore we saw the huge contraction of 8%. In terms of inflation, we have seen inflation coming down quite substantially since 2019, where the average inflation went down to 2.2% in 2020. We've seen a slight uptick over the last 2 months, and this is now to the end of February. However, this inflationary increase was largely driven by the transport sector as well as our housing sector, which make up a significant portion of our NCPI index. So we are expecting interest rates to remain low or moving sideways well into 2022. So we do not foresee material changes in inflation. And if we look at the breakdown in terms of the NCPI, Namibia Consumer Price Index weights, one sees that our NCPI index is heavily weighted to housing, transport, and food and non-alcoholic beverages. Those three sectors alone make up close to 60% of our inflation. So when we see changes there, like we've seen over the last 2 months, we see the inflation numbers moving. However, the spending patterns of Namibians have changed since 2012, and therefore we do expect a review over the long term to make it more reflective of the reality on the ground. In terms of unemployment, the last labor force survey was done in 2018, and the next one should be done within the next year or so. So the official numbers still stand at 33%. However, considering that we had the deepest contraction in history, we definitely expect unemployment numbers to move up from 33%, and youth unemployment to be even higher than that, because already in 2018, when this survey was done, youth unemployment was close to 60%, particularly for the group of those aged 20 to 24, and for the age of 25 to 29, around about 40%. Which is quite material when you have a significant portion of our productive labor force that are not employed. If one looks at the government expenditure, we basically see that since 2012, 2012 was the last year where we had a positive budget balance. And since then, we have been in a deficit from 2013 right through to 2020. And what we have seen is that these budget deficits have increased quite materially. If you look at the 2020 financial year, the budget deficit increased to 16.6 billion Namibia dollars, which is the highest budget deficit that Namibia has witnessed since 1990. Now, the challenge with running a budget where expenditure is materially higher than revenue, the major challenge that we are seeing is that most of the expenditure is not going through to efficient expenditure. So if we look at the expenditure portion here in the 2020 financial year, close to 50% of that is basically spent on personnel costs on government. So we have seen the government trying to address this. through freezing vacancies, trying to reduce headcount, and also natural attrition, and not replacing certain individuals within the public service as they go on retirement. So we do expect this number to come down. But even though this number is coming down, because it's a structural issue, it's very difficult, and it's going to take several years before the government can actually see the positive days that we saw in 2020, where revenue was actually higher than, sorry, in 2012, when revenue was actually higher than expenditure. Another key risk is that when we look at the source of funding of government, the primary source now is debt. So we are living on borrowed time. 16.6 billion is funded through debt. The second highest is SACCO revenues, which is about 14.8 billion. However, the challenge is we're expecting SACCO revenue receipts to possibly come down over the next 2 years. And then we'll also see that in terms of the tax base, income tax is about 14.4 billion. However, the majority of the taxpayers are employed by government. And with government now having the plans to reduce the labor force, we could see that number also being impacted. We've also seen some concerns around corporate tax, where the government has not efficiently collected revenue from several of the large corporates, particularly multinationals, that have capital flight, elaborate tax structures where the shareholders are sitting outside of Namibia and so on. So although these companies make a lot of revenue, on the profit side, we see that the profits are lower, and they've found ways to basically export the money out of Namibia. So the good news is that fortunately now, the Namibia Revenue Agency has been set up, and their mandate is to try and improve the efficiency of tax collection, because there's a lot more potential in terms of corporate tax, particularly in the Namibian context. So in conclusion, when we look at some of the key risks that we foresee in the Namibian space, is definitely the increase of unemployed people, especially amongst the youth. It leads to populism. And we've seen in Europe or even in America how populism gets leaders elected, and even in the local context, where some of the political parties have started or have rode the wave of populism to get elected into parliament. And then the second challenge is our unequal society. We are one of the top 3 most unequal nations in the world. This does not only provide a burden to the state, but it also provides challenges in terms of crime and other social issues. So we do expect a lot of challenges in that area, and to try and rectify that is very difficult. And hence the government has started implementing NIAB, where they try to address this. It's not a simple matter to address. We do believe it will take several years, but efforts are being made there. And then, of course, what I spoke about earlier, the over-reliance on government in order to grow the economy. It did well for us pre-2016. However, we've seen as government wasn't able to grow the economy that efficiently anymore, the whole economy has basically been in a recession ever since. And yet we still see that we need to diversify away from that. And then also clear implementable plans with milestones, focusing on sectors with strong multiplier effects. So we've seen a lot of policies that are brilliant with excellent intentions, NDP 1 to NDP 5, Harambee Prosperity Plan 1, and the second one that has recently been launched. But we have not seen those plans deliver the kind of economic growth that we would like to see. And then the third concern is that now that debt is the #1 source of funding in government, it's a very fine balancing act between the debt burden that we have as a nation and economic growth. And then the last point is foreign direct investment has actually become a lot more important in terms of growing the economy. Well, thank you very much. I'll hand over to Marius, who will take us through the views on the Inflation Plus Fund.
Thanks, Shivi. If you can just stop sharing your screen and I'll start sharing mine.
Okay, thank you.
Thanks very much. Good morning, everyone. Goeiemorgen almal. I hope you're all well and that the year started off a little bit less frenetic than I think our year, where we remain in lockdown and we're not yet in the office. And of course, markets are have started the year off with a bang in many different ways. Chantal, I hope everyone can see my screen. I think just further to Zandria's earlier comments, I'm Marius Oberholzer. I'm the head of the newly renamed STANLIB Multi-Strategy franchise, and I'm stepping in for Vaughan Henkel, who decided to leave STANLIB's employee recently. So I'll take over the management of this fund myself as the head of the investment team going forward, and happy to take any questions either later or offline on a one-on-one basis. Just to set the stage for really what is our asset allocation and what is our team's thinking as we move into the second quarter of 2021. Ultimately, we can't get away from three major factors. The central banks of the world have brought what can only amount to warlike response to the COVID pandemic, which hit the markets and hit economies just over 13 months ago. And we've had an enormous amount of response, both with central banks cutting interest rates, with quantitative easing policies, whether you call it QE, yield curve control in places like Australia, additional issuance in bond markets from the likes of the South African Central Bank or South African Reserve Bank, the continued quantitative easing policies in places like the United Kingdom and Europe. And it really has then been augmented towards the middle part of last year with an enormous fiscal response from the United States, especially, where they are now literally mailing checks to their citizens in the effort of keeping not only the economy buoyant, but also of keeping the real debt trajectory, which could become quite ugly, both from a consumer perspective and ultimately from a corporate perspective. So to keep that market going and keep the banking sector whole. At the same time, of course, at the back end of October, we had a very fast response from the medical community. And for all President Trump's naysayers, it's the one thing he did do was accelerating that vaccine process and making funds available to the corporate sector around the acceleration program from that vaccine research. And as we know, there have been a number of success stories across the medical community with a number of vaccines being rolled out with different efficacies. And that's really allowed investors like us to get a little bit more certainty around what the recovery trajectory will look like, and ultimately what the future will look like, even though what the normal world was just a few short years ago or a few short months ago is going to look very different going forward, we think. And then ultimately, because of those twin-pronged attacks of a better vaccine program, huge amounts of stimulus in the market, and a reopening of economies from these kind of enormous lockdowns that we've seen around the world, we ultimately believe that the world is reopening, and that will drive, we think, returns from a risk asset perspective in the short to medium term. Longer term, it becomes a little bit more difficult, and maybe we'll touch on that later, but we don't have a lot of time, so I'm going to whiz through a couple of key points in our thinking. Now, the first part to talk about is ultimately that liquidity, where we've had $29 trillion pushed into markets over the last decade, and you can see the acceleration through this chart of total central bank liquidity injected in markets. This doesn't talk about the fiscal responses that we've seen, the Biden plan, the Trump package in the middle parts of last year, as well as the supportive policies from other governments around the world. And ultimately, this is a big shift where the world has moved from monetary policy, an abnormal monetary policy of quantitative easing, into fiscal policy. But it's been an enormous inflow of capital into asset markets, into economies. And the big question for everybody is is this a game changer? We do think it's a game changer. It may well bring about inflation. It's one of the things that we'll chat about as we chat now. It may well bring about inflation, but it does act as a buoyancy for markets, for asset prices, with some caveats around that. But it's been unprecedented, this type of push of liquidity into the markets. As I mentioned, the vaccine program, in terms of the various efficacy rates that have come through from the different medical companies, have resulted in a really rapid rollout in certain countries around the world. The United States has done an impressive job of late in terms of vaccinating people. And we believe, especially after last night's comments from Governor Bullard in the Federal Reserve, that you could potentially get to around 60 to 70% of the United States having been vaccinated by June or July. It's slightly ahead of our model, and please go and have a look at the STANLIB Thought Leadership website, where we've done a lot of modeling around the rate of this vaccine rollout. And the big thing for us in Southern Africa is that the vaccine rollout in South Africa and Sub-Saharan Africa is much slower than the developed world. And that's not because our governments are inept. One might say they are inept, but it's really around the reality of not having enough vaccines to cover the developing markets specifically. And as a result, we will be a slightly lagged recovery profile to developed markets. And you can see that South Africa's only vaccinated 290,000 people relative to the rest of the world at 788 million. And these numbers were pulled yesterday, so they're pretty up to date. And places like the United States and the UK accelerating dramatically, and Israel, where the vaccination program is almost complete. Now, with this vaccination program taking place, you can see that the economies are reopening, and many different states in the United States are reopening. And this is an indication of air travel happening in the United States, and you can see it's improving quite dramatically. You know, there are full stadiums at baseball games now, and many states have exited the lockdown profiles completely. Of course, UK came out of lockdown, or its really strict position of lockdown, and Europe and places like India are still struggling with their own kind of lockdown processes and the effort or the vaccination program. So not all countries are going to come out of this at the same rate. And I think it's important to note that. And that's one of the reasons why we've seen the better performance in the United States up until now, relative to places like Europe or the emerging markets. Now, the economic profile, I won't belabor the point too much, because we've heard around the economy already, but you can see from the Purchasing Manager Index activity in manufacturing on the chart on the left-hand side as you look at your screen, everything is accelerating as these economies reopen. In the services sector, which makes up a majority of the developed market economy, ultimately not quite as strong, because services remained intact for those kind of companies that could continue to work from home. But the manufacturing environment, exports picking up, and real demand for goods as companies come back online. And that's been a major talking point in the economic and investment community around what this does to prices. Because global trade, even though it is buoyant, it is hard to find the ability to get hold of logistics. I'm not quite sure about you guys in Namibia, but in South Africa, it's very hard to get industrial goods, and even things like, the well-known shortages of semiconductors for auto manufacturers and even bicycle parts. It's almost impossible to find them right now. And so these bottlenecks can create a short-term inflationary pressure, which we were expecting. Now you can see here, in terms of the inflation surprise index measured by Citibank, the inflation since the sort of fourth quarter of last year has really accelerated to something that we haven't seen in the last 15 or 20 years. And as I mentioned, that's really around the shortages of goods, the logistic bottlenecks that we're seeing, whether it's shipping, whether it's trucking, finding enough drivers to move goods around, and certainly for corporates to have enough cash to deploy their working capital to get hold of those inventories that they can then on-sell. And the problem is, of course, is you can go and build an inventory level as a business, but you're not quite sure what end demand looks like, because the consumer is under stress with job losses, savings rates drawn down, etc. So it's still a fairly uncertain time. The reality, though, is central banks, despite this rhetoric around higher inflation, central banks have cut interest rates dramatically. We've seen in the emerging markets as bond yields in the United States, specifically sort of from October, that have backed up. So bonds have lost value and yields have increased, and Sylvester will talk about that later, has really resulted in a couple of emerging market central banks raising interest rates. So Russia, notably, we had Brazil raising interest rates, and then we had Turkey, where we've had a number of changes of the central bank governor. But those are important to note because from a South African and a sub-Saharan African perspective, that's the kind of neighborhood we sit with: Brazil, Indonesia, India, Turkey, Russia, etc. And when they're raising interest rates, they're really doing it, because they are seeing some inflationary pressure, notably Turkey and Brazil, but also preemptively because of the strength of those US yield curves, so the bonds falling in value, yields going up, and potentially the strength of the currency, where everyone came into the year thinking that the dollar was going to be much weaker. The dollar's maintained its fairly robust strength. Now, one of the things that we think is coming at us is ultimately, Chivi mentioned the disparity in income groups, or the Gini coefficient between the haves and the have-nots, the poor and the wealthy. And it's really notable in the United States how disparate the wealth gap is and the income gap is in the United States. And I show this. The chart on the left-hand side is the 50th to 90th percentile. So this is the higher income earners, what you would classify as middle class, has had its wealth destroyed. The 90th to the 99th percentile group over the last 10 years has kind of kept pace, but really it's the 1%ers that have made all the money as these markets have inflated. Now, we think this is important because the Federal Reserve, really being the central bank of the world, has recently revised its framework around interest rate policies. And ultimately, they are targeting average inflation, where previously they targeted 2%. Again, I think Sylvester will discuss this. They've also mentioned that full employment, which is one of the cornerstones of the Federal Reserve's framework, needs to be reached. But ultimately, full employment means inclusive employment as well, for a lack of a better term, which means that they're looking at racial differences, educational differences, to ensure that the economy becomes more inclusive. Now, we think that's a key point because it's going to mean, despite this inflation rhetoric, that the central banks of the world are going to keep interest rates low. Not only because the debt levels are so high and they cannot afford to raise interest rates, but because they want economies to become more inclusive. And I think this is something that's really understood by us in sub-Saharan Africa, where this wealth gap and income gap is so great. So going forward, we think that the policy response will be very dovish and rates will remain lower for longer. It's been our predisposition for many years, but ultimately this continues to cement that thinking in the ensuing 12, 18, 24 months. On the flip side, we've had the Biden infrastructure plan, more stimulus coming to market, and ultimately Joe Biden has said that they will raise taxes. Now, we've seen the United Kingdom raise corporate tax from the lowest in the world to slightly higher as they try and pay for their own policies. And you can see on the chart on the right-hand side, the United States individual income tax rates has never really been lower in history. And ultimately, the Biden's government will need to pay for these infrastructure plans, for the fiscal plans that they have put in place to support the economies and to support consumers. And so we are seeing that rhetoric growing and an announcement around a desire to increase individual income tax, capital gains tax, corporate tax. All of that affects the valuations that you would apply to something like an equity market and potentially something like the fixed income market, which we can ask Sly about a little later. From a valuation perspective, it's very difficult to make the case that equities around the world are cheap. We think equities are reasonably rich. I'm showing you here a number of countries and an aggregated Z-score, so the standard deviation relative to a 20-year average of a number of countries around the world. And keep in mind that no stock market is fully reflective of the economy. But if you have a look at South Africa, it would appear that based on the last 20 years that the South African stock market looks reasonably cheap, especially when looking at something like the United States or Asia on the left-hand side, where stock markets would appear to be reasonably expensive relative to the last 20 years. Now, the problem here is that as bond yields go up, it makes your cost of capital a little bit more expensive, which should traditionally mean a compression in multiples. We haven't quite seen that yet, but the million-dollar question is what has been priced, and should interest rates go up, not necessarily from central banks raising rates, but from investors like Sylvester and Victor, who run our bond market, deciding that actually the risks to bonds are very high and they want to reprice those higher. That will change the dynamic in equity markets. We don't think we're there yet. We do think central banks will stand pat and they will continue to engage in these extraordinary policies like quantitative easing and yield curve. So we do think tactically that it continues to pay to take risk. Now, the problem in South Africa and to some degree in Namibia is that our bond markets are so cheap relative to equities that it still, as yet, on a risk-adjusted basis, doesn't pay one to be too aggressive on equities relative to bonds. Of course, if the growth comes through, if we get things like resource demand, as trade picks up, we want to be exposed to equities and to risk assets. But ultimately, from a risk-adjusted basis, and especially in something like an absolute return, inflation-protected fund, it doesn't pay us, where we are looking to protect capital over rolling 12 months, to be very aggressive with equities. Around the rest of the world, of course, the equity risk premium is very high, and ultimately relative to those fixed income markets in places like Europe, Australia, Japan, you want to own equities. Now, I mentioned equities are expensive. The only way we can really justify equities being this expensive is if those earnings come through. And later this week, we'll start the earnings, the quarterly earnings kind of reporting season in the United States, where banks will be first off the rank, and we're going to get a feel for how much extra profit these guys have generated over the last quarter as economies are starting to normalize, and what has been priced in. If those earnings don't come through, these markets are going to look really, really expensive. And if we continue to have an inflation uptick, which in the short term we do believe is possible, markets could become a little vulnerable. And keep in mind that they have done really well year to date already. I'm talking specifically about the US, Europe to some degree, not so much emerging markets. And certainly South Africa has done well as well. So for us, in closing, I'm going to give you our quick thoughts. Bond yields backing up. We fully expected that to be the case. Sylvester will talk about it. We knew inflation base effects would kick in. There's likely some more to go. We think bond yields could potentially in the United States go to 2%. That will put upward pressure on other bond yields like the South African and Namibia bonds. But ultimately, we think the Federal Reserve and other central banks will allow the economies to run hot, and they will not raise interest rates over the tactical horizon of 12 months. We think that the curve, the interest rate curve, could impact equities because the equity risk premium isn't as high in emerging markets as it is in developed markets. And so a place like South Africa, China, as we've already seen, India, these emerging markets could struggle a little bit relative to what we thought at the beginning or the back end of last year. We've already seen the South African short-term rates, futures market, the FRAS market, price in an interest rate hike over the next 12 months. It's come back a little bit. Again, Sylvester will talk about this, so I won't steal his thunder. The Biden stimulus is live. There's more money flowing into these markets. We believe we're close to peak liquidity, which is something that the markets will have to navigate likely in the second half of 2021 and into 2022. We do think the Wall Street versus Main Street is a big issue for markets to navigate. And as the markets move from a world where central banks and policymakers have supported asset markets, they're going to now be much more focused on supporting economies rather than asset markets. That could create some wobbles. We think South Africa is far behind the curve in many fronts, notably the vaccine rollout, which means our recovery is slower. We have our structural issues. Chivi mentioned the fiscal situation in Namibia, and that will translate into sub-Saharan Africa, especially with the cross-border payments, etc. We think South Africa deserves a discount to the rest of the world, but tactically we remain predisposed to risk. We want to be involved in equities. We don't think it's yet time to take risk off the table, but we are notably focused on protecting your capital over a rolling 12-month basis. The final point I'd make is that I've been investing in emerging markets and places like Japan for my entire career. And I've seen this movie before. And one of the things that we came to the market with in 2016 is that we believed that the market was moving into very short, sharp cycles. We think that's been accelerated, and we note that many of the sell side houses are now calling for the same. And we think we're 12 months into that recovery. If Japan is a proxy on what the world looks like going forward, given its deflationary forces, and the expensive equity markets that we had in 1989, that doesn't mean that we're bearish, but we do think that the cycle will be much shorter than previously was the case. This is a very unusual cycle. The world looking forward is going to look very different to what we had in the past. And as we look 12 months out, Zandria will send us out to you. You can see our asset allocation, our predisposition. This doesn't tell you what our portfolio is doing, but it tells you where we focus. And you can see we like South African equity at the margin. We like South African fixed income at the margin. We like global equity. So a big cyclical bet to our portfolios. We are trying to take prudent equity risk. And as volatility falls, which we've seen over the last 2-3 weeks, we will be able to take more risk in a volatility controlled fund. You can see the downgrades. We've moved China to a downgrade. We've increased the US sovereign bond predisposition on our views. We don't hold any, but we're liking it more and more from a portfolio construction aspect. And we've moved ourselves away from credit, where we had a very strong view 12 months ago, to less strong view and more focused on emerging market, high yield, but ultimately taking our bets in cyclical equities. And I think that's enough from me. We'll take questions later, and I'll hand over to my esteemed colleague, Sylvester Kobo, the Senior Portfolio Manager in our fixed income team. Sly, I'll stop sharing and over to you.
Thanks, Marius, Shivi, and Zandria. So Marius and Shivi basically went a lot into the economics. I will specifically be focusing on our Namibia Income Fund, given that the economics has been covered and we are under time pressures. And I hope Zandria will give us a bit more time after 12. Sorry, this is the wrong screen. Okay. Good morning, everyone. First, to start off, as I said, I will be focusing on our Namibia Income Fund update. So I'll touch on how the fund is positioned currently, and also go into performance. I know there has been a lot of queries around performance, especially in February. And then I'll also touch on our expectation outlook in the end. So in terms of how this portfolio is positioned, you can see it is very well diversified in terms of underlying instrument holdings, which is quite key, especially in a challenged environment that Shivi was alluding to earlier. We've seen a pickup in the corporate space activity, especially in private markets. So there has been 1 or 2 auctions that came into the public space, Standard Bank Namibia being one of those. But also in the private space, we've been able to see good deals that we have used to invest more of the portfolio. So we've utilized the cash that we have been holding for some time now. And I can happily say the portfolio is fully invested at the moment. But as you can see, over half of this portfolio is sitting largely in banks. And that's a function of 2 things. One, demand and supply. There hasn't been good rated counters in the Namibia and also in the SA space coming to market. It's largely been banks. And so from a rating point of view, we'd rather assume a more defensive position there. There's also 28% exposure to government, so 17% in South Africa and 11% in Namibia. And why the difference between the two? So as we know, South African government bond market is more deep and liquid. So this gives us more nimbleness in terms of trying to move around the portfolio compared to the illiquidity that we find in the Namibian government's bond market space. But also more importantly, and it talks to what Shivi said around the debt burden in Namibia. You know, the Namibian government is facing big maturities this year, and they have said they will basically use the bond market to refinance those because they actually ran down the sinking funds last year during COVID that they put aside to redeem these Euro bonds. So we expect more issuance to come through in Namibia. As we know, their debt to GDP has doubled in the last 5 years to just over 60%.
I am Sylvester, sorry. We are just seeing your holding slide, your Standard Bank Income Fund update. We are just seeing that slide.
Is it?
Yeah.
Sorry.
Yes, there we are seeing the right one. Thank you.
Thanks. Sorry about that. Thanks, Andrea. So yeah, as I was saying, 50% of the portfolio is in banks because of the demand and supply issues, and also given that the non-banks that we've been seeing come into the market were largely lower rated counters, which we're staying away from in an environment that we're in now. 17% holding in South African government bonds, 11% in Namibia. As the last point before Zandria corrected me was on Namibian government bond markets, where we're expecting them to ramp up issuance this year to redeem that $500 million Euro bond that's coming up in November. They have used up most of the sinking fund that they put aside to redeem the bond this year and next year as well. Government debt to GDP has doubled in 5 years from to over 60% now, and their target, as we know, is 35%. So our expectation is this will put Namibian government bonds under pressure, especially the longer dated bonds. So we expect the yield curve in Namibia to steepen further, but also the spread between the Namibian bonds and South African bonds to widen. To take the GC27 as an example, previously it used to trade at around 200 basis points to the R186 bond, which is a companion bond in South Africa. But with the introduction of Regulation 13 and so forth, that spread narrowed down to at some point around 20 basis points. But it has since normalized to currently around 80 basis points. So as they ramp up issuance this year, we expect that to widen further by another 40 to 50 basis points, in which case, we'll see value in rotating out of South Africa into Namibian bonds. The fund size currently is 1.3 billion Namibian dollars. Higher credit quality, as I said, so in a recessionary environment, especially in Namibia, Namibia growth, as Shivi has said, has been negative for quite some time. So in a recessionary environment where there's a lot of uncertainty that's brought by COVID, you obviously want to be defensive as defensive as possible. And we've taken the deliberate decision to move away from lower rated instruments and as you can see, about 3/4 of this portfolio sits in a AA and higher, which presented challenges for us last year around this time when we started seeing, as Marius said, central banks responding to COVID in a big way. Both the Bank of Namibia and South African Reserve Bank cut their interest rate by 300 basis points, which for us meant we were faced with a situation that if we just leave the portfolio as is, you are going to get the yield of this fund moving closer to CPI. And as we know, we target the portfolio to give you much better returns, so closer to over 200 basis points higher than where inflation is. So we could, as I said, leave it as is and take the yield dilution. And as we hit that as clients, you're not going to be happy with that. You're probably going to withdraw your money. The second choice for us was, go into higher rated instruments, which are lower credit, but I spoke about the volatility and uncertainty brought about by COVID. That was not a chance we were willing to take, because that could have actually led to losses. As you know, or poorer balance sheet companies are first to go in a very bad environment. So we shelved that, and the choice we went with on our side was to actually fix most of the, or a big portion of the portfolio to defend the yield. So we increased the fixed rates by buying government bonds. That's why if you look maybe 13 months back, we had less than 5% government holding, and now it's sitting closer to 30%. And that has allowed us to defend the yield of the fund. As you can see, the spread between the fund yield prior to the rate cuts and 3-month JIBAR was sitting at around 100 basis points. And because of our action, that has now widened up to about 300 basis points. Current yield of the portfolio is around 6.98%, meaning, on average, you can expect to get about 7% gross return this year, compared to 2.7% inflation, as Shivi mentioned earlier, and a very low JIBAR rate. But the increase with fixed rate comes with the increase in duration of the portfolio. And as we know, the higher duration means the portfolio is now more sensitive to bond movements. And as we saw in February this year, where bond yields, I'm using the R186 as an example, sold off due to global reasons that Marius spoke about, mainly with the US treasuries now or investors coming alive to the fact that inflation this year will be higher, and now treasuries reacting to that and moving higher. So our bond yields also followed South African and Namibian bond yield, and because you have a higher duration than before in the portfolio, that led to NAV reduction in the portfolio. But we've since stabilized, as Marius had said, even though we know US treasuries at around 1.7, probably as more inflationary data gets released over the next 6 to 9 months, these can move up to 1.8 to 2%. The Federal Reserve has been quite clear that they will allow the economy to run hot, because they believe the increase in inflation will be transient, and they are targeting average inflation, as Marius had said. So we don't believe they will be raising interest rates for the next year to 2 years. That's why we've started to see bond yields stabilizing and also the NAV of the portfolio improving over March. Still, what I'm trying to show here is over the last 5 years, even though in the short term, especially when you're looking at the portfolio on a monthly basis or daily basis, you will be subjected to the volatility in NAV or in returns. Over the past 5 years, you can see how stable and consistent the returns of this portfolio has been. So if we had put in $100 Namibian 5 years ago, it would be $153 now, compared to the benchmark, which is the composite of $139. But compared to other major asset classes that are very volatile, you can see when you look at the portfolio performance over a longer time, how smooth and consistent that return is. And obviously, as an investor, you want to get as high returns as possible, but with very low volatility, which is obviously not always possible. What I'm showing here is, how the portfolio over the past 3 years have performed. And the picture is the same for 1 year or 5 years, compared to other asset classes, where if you look at, say, South African bond returns over the last 3 years, giving you similar returns to the Namibia Income Fund, but you can see volatility sitting closer to 10%. Same for equity, property actually losing you money with 30% volatility over the same period. But this fund still gives you compelling returns with volatility of around 1% and low, which is why we are comfortable that going forward, given that the volatility in the fund is low, if you smooth out the return over the next year, you will get similar returns that you have experienced in the fund previously. So what I'm showing here is now to try and look at it on a monthly basis. You can see how unstable or volatile these returns can be, which is why we always say to clients, it's not a money market fund. It is subjected to market movements. As Marius has pointed the picture of how bond yields sold off or over the month of Feb, it will obviously be impacted by that, which is this negative return here. But over March, it has since made up back those returns, which is why we're saying, if you look at it, the way you should look at it as a 1 year plus fund, the fund will still continue to deliver. We've returned consistent alpha over the 1, 3, and 5 year space, so 1.8% as at the end of March. And we still expect over the next year to give similar returns in the portfolio. Yes, the gross number has dropped from 7 to 6.3, but remember this includes the highly volatile and negative return period in March and April of last year. These numbers will wash through. As I said, the gross yield in the portfolio is sitting closer to 7%, meaning we can expect to get about 7% in the portfolio over the next year. Yes, in the short term, there will be those times where it's returns are lower or NAV dips and goes up, but over time, we are comfortable that the way we've positioned ourselves in the portfolio, it will still continue to deliver to our promise. And yeah, that's it from my side. I will hand over back to Zandria for the Q&A.
Thank you so much. So the questions, the first one would be, do we expect changes to Regulation 13? Shiri, I think that one is maybe for you.
Okay, thank you. So in terms of Regulation 13, there has been talk about changes to the domestic asset requirement. However, that has not been formal talk. It's still more so in terms of rumors. So we don't really want to comment too much on rumors. We do expect that if we do increase from 45%, the challenge will be, and maybe Sly, you can come in here after, prices will be distorted in the bond market if we do increase to 50 or 55%. So it's not in the best view of the investors, and the majority of the pension fund investors being government investors who basically have the majority of their portfolios invested in fixed income. But I think we would rather wait for such discussions to be formalized before commenting too much.
Yeah, maybe to jump in there as well. I don't believe, especially over the next year to 2 years, we're going to see changes there, given that also many of the local pension funds are still yet to fully adhere to the changes in regulation. And as we've seen, the government is actually tried to say, given that the maturities that they're expecting, or the Eurobond maturities in November and next year in hard currency, they can try and do a sort of a swap with pension funds that are not adhering to take their offshore hard currency investments in exchange for local government debt, which will get them to that 45% requirement. So until you see that adherence or compliance to the regulation, I don't think you get a situation where they now have to increase it to fund themselves. There are a lot of efficiencies that the Namibian government can sort out internally before heading that route.
Thank you. Okay, I'm going to combine this question. The question of the client will be, do STANLIB see investment changes that would increase returns in the next few months? That is maybe for the income fund. And I'm going to add Chris van der Merwe's question that according to Morningstar, our peers are doing 7.21% and we 5.4% on a year-on-year basis. Do we expect this fund to, how can I say, come back to that levels after what happened in February?
Yes, so as I said in my presentation, we do expect it to, well, not to the 7.2 one that the peers are doing, but more to the 7% level, which is where we're comfortable with. We do not see the need to put in even more risk given the challenges in the bond market that we're expecting, especially from the Namibian point of view, over the next year to try and make up that extra 20-30 basis points. We're comfortable with 7% return in the fund. Inflation expected to, well, it will edge higher from the 2.7 currently to about 3.5-4%. So if the fund gives you 3.5% real return, that delivers to the promise, and we're happy with that.
Is there no further questions? Let's see. No further questions. Okay, yes, for the Inflation Plus Fund, you like resources, shares, and are neutral copper, gold, and platinum. Yet the Standard Bank Namibia Inflation Plus Fund has no resource counters. Marius.
Yeah, I think, is that from Henry?
Yes.
Hello, Henry. Henry, I'm going to answer in English, if that's okay. That's right. We don't have exposure to resource counters directly. We are trying to keep this fund as liquid as possible, given the uncertainty. The strategy is predisposed on trading at the index level. So we will be buyers of futures predominantly, or options when we take our equity exposure. Through taking that index level exposure, we do pick up the underlying resource counter exposure, which makes up a dramatic portion of the South African equity index. So we are by virtue exposed to platinum stocks, the likes of Billiton, the likes of the bulk commodity plays. But we are not buying shares in these companies. We are predominantly an asset allocation strategy with some very targeted single stock positions when appropriate. We don't hold very many single stock positions at all. In fact, if we hold any, it's maybe 2. The reality is we are trying to play in the liquid space because it allows us to hedge your portfolios more efficiently. Remember, part of what this fund is trying to do is give you a smooth return profile, generating around a CPI plus 4 to 5 over the 5-year period. So that would translate to an equity type return without equity volatility. So in the short term, it can look noisy, but ultimately we're not picking stocks here. We have, not for this fund, we have other funds where we're picking stocks, and there we do have interest in resource counters. So why we show you that asset allocation is I chair the STANLIB Asset Allocation Committee, where guys like, or not committee because we all operating independently, but where we're really putting our heads together as a combined wider investment team to try and find the best investment views that we can interrogate our own views. But what you saw there is an output of my team for the quarter going forward. So where we like resource counters is because we are worried about this inflation. We don't think inflation's coming through in the medium term, but in the short term, we do want some inflation protection. We think it's too soon for inflation. I think in 3 years' time or 2 years' time, you'll see much more of a resource bend. But we're picking up enough exposure in our commodity counters that are listed in South Africa at the index level. Henry, I hope that answers your question. If you want to dig into it more, given the time constraints, we can chat one-on-one, no problem.
His answer was okay.
Okay, great.
Okay, so we ran out of time. There's one more question which we will definitely attend to afterwards. Thank you so much for everyone. Thank you for your time. Thank you for the questions, Sylvester, Marius. Thank you for taking the time out to assist us or to present to us here in Namibia. We really appreciate it, and we really appreciate your time and all the efforts you put in for us and for our funds.
Thanks.
It's a pleasure, and without maybe I'll answer for Sly as well. Please, by all means, if you've got questions, we're very happy. Both Victor's team through Sly, my team, to answer questions directly on a one-on-one basis if you need them.
Definitely.
We will definitely do that. Thank you. Have a great day, everyone. Bye-bye.